If you operate a 501c3 and you want to add a revenue-generating activity, you have a range of options, from structures that will allow you to do the activity very independently, to collaborating with another organization, to actually combining with another existing organization.
The first and most simple option is to add the new activity by yourself and within your existing organizational structure, not creating any new structure, although you might add a division just from an internal operating standpoint for management and accounting purposes. This would be appropriate if the activity that you're looking at adding is substantially related to the organization's mission, or if it's an unrelated activity, but it will be small relative to all the other activities that the organization conducts.
If you use this structure, you'll want to make sure that your new activities don't drift you away from your core mission, and you'll also want to watch the growth of the activity if it's an unrelated activity. If it grows to be substantial, it can jeopardize your tax-exempt status.
The second option for structuring a new earned income activity is to do it through a subsidiary, and there's actually two options under this one. The first one would be to use a single-member LLC. The advantage of this is it provides liability protection for the parent, but it's treated as the same entity for tax exemption and tax reporting purposes. This would be the structure to use if it's a related activity or if it's an unrelated activity, but it will be small relative to the other activities that the organization conducts.
Or you might decide to put your new activity into a taxable subsidiary. That would be a good choice if the activity is unrelated to your mission and it's substantial when you compare it to the rest of your operations. A taxable subsidiary is going to offer liability protection, and it's also going to protect your tax-exempt status. The profits would be distributed to you as dividends, which means they are not taxable, but you do need to respect corporate formalities, and you need to make sure that the transactions between the parent and the sub are at arm's length and are at fair market value.
You might also decide to conduct a new program with a partner in a joint venture, which would be appropriate if you have kind of the will and the desire to begin a new program because you want to generate revenue or otherwise expand your programming, but you don't necessarily have all of the expertise in-house. If you do decide to work with a partner, you can do it either by contract or you can form a new entity in order to house the joint venture.
If you are going to work with a new partner with your venture, you need to remember that the profits and losses of that activity need to be in proportion to each of your partner's ownership in the venture. You're going to need to value the contributions that each of you put into the venture at fair market value, and if you're working with a for-profit partner, you need to retain control over your exempt mission. You might also decide to combine your operations with a partner. This could be appropriate if you have compatible missions and values and culture, or you have a need for capital, efficiencies, or you can gain economies of scale.
Now, one option in a full combination is to do an asset transfer. And in an asset transfer, you have the opportunity to isolate both known and unknown liabilities from being transferred to the organization. And in a merger or consolidation, all of your assets and liabilities transfer by operation of law. The effect of either of these types of combinations is that all of the assets and liabilities of the entities will combine into one operating entity.